You're listening to the Options Insider Radio Network, the home of the Options Podcast. For more quality options programs, visit theoptionsinsider.com or search for Options Insider Radio Network in your podcast provider of choice. Listeners can also access all of our programming through our mobile app available in the iTunes and Google Play stores. Select programs are also available via live stream at mixlr.com/options-insider. That's mixlr.com/options-insider. Don't forget to follow along with your favorite programs and submit your own questions for the hosts at twitter.com/options, stocktwits.com/options, facebook.com/theoptionsinsider, or via questions at theoptionsinsider.com. It is a dangerous world out there. Volatility is on the rise, and your clients' portfolios are under assault from a growing number of threats. Simple diversification is no longer enough to shield the assets under your protection. Registered investment advisors, financial planners, and asset managers need a new weapon in their war on risk. Welcome to the Advisor's Option, the program designed to arm busy advisors with the information necessary to properly manage risk in this volatile environment. From options education, trading strategies and tips, to industry news and interviews, you'll find it all on the Advisor's Option. The Advisor's Option is brought to you by the Options Industry Council. The OIC was created to educate investors and their financial advisors about the benefits and risks of exchange-traded equity options. For more information on how the OIC can help you implement options in your practice, please visit optionseducation.org. The Advisor's Option is also brought to you by SWAN Global Investments. Since 1997, SWAN has been the leader in hedged equity and option income strategies with GIPS verified results. SWAN provides unique and valuable solutions to the inherent weaknesses of asset allocation, offering defined risk strategies that allow upside participation while also protecting advisors and investors against market risk. For more information about our advisor program for separately managed accounts, SWAN defined risk mutual funds, or our proprietary option overlay strategies, please contact Randy Swan at swanglobalinvestments.com. Think outside the style box. Think SWAN when deciding on risk management solutions to market risk. The Advisor's Option is also brought to you by Option Research and Technology Services. ORATS is your source for options backtesting. It's where you turn your ideas into results. Founded on the floor of the SIBO over 2 decades ago, ORATS is a full-service option research firm focused on helping you develop options strategies in line with your investment objectives. With a state-of-the-art backtesting platform, scanning, and implementation tools, ORATS offers end-to-end option strategy development, making the whole options trading process easier. For information about backtesting, scanning options data, including dividends and earnings, visit orats.com or email Matt Amberson at matt@orats.com. And now, it's time to learn how to implement options in your practice. It's time for the Advisor's Option.
All right, everybody. That music means it is time for a special Friday edition of the Advisor's Option, the program here for you, the busy financial advisor and asset manager. Maybe you're wondering how you can incorporate these products into your clients' portfolios. Maybe you've already tried. Maybe you had success. Maybe you didn't. Either way, we've got you covered. My name is Mark Longo from theoptionsinsider.com, as well as, of course, from this network upon which so many of you have been mainlining every day this week and for months now. We love to see so many new folks discovering the network week after week and month after month. We want to keep that flow coming. It's more important than ever in these trying and difficult times for everybody out there. So if you like what you hear for this show, for the entire network, make sure you leave those comments, those reviews on those platforms where you listen to it so new folks can continue to discover all of the content we're putting out there these days. And, of course, keep those questions coming, too. You guys really hit us up and bombard us on this show. We'll try to make sure we get a bunch of you on this show as well. And speaking of joining me on the show, let's see who's joining me on the Old Advisors Option Program today. First, let's begin our journey far to the frozen north. Not quite that frozen yet, but maybe it'll get there soon. All the way out to the land of New Hampshire. No, we were just beaming into Maine. Now we're back out to New Hampshire. Right next to it there, where we are going to the land of ORATs, a.k.a. Options Research and Technology Services. We are joined once again by the Oracle of New Hampshire, Mr. Matt Amberson, the founder of said ORATs. Mr. Matt, welcome back to the program, sir.
It's not frozen yet, Mark. It's not frozen yet. We are sitting outside in the sun today, and a fox stole a rooster from our neighbors. So, I mean, there's a lot going on here still.
It's serious business. We have that problem all the time here in downtown Chicago. I can't remember the last time, just every day it seems like the foxes are just rampaging our hen houses here in Chicago. So different problems for different local areas here. Then we're going to dial that hand all the way down to sunny and scenic and sometimes tempestuous this time of year, Puerto Rico, where they have all sorts of other local problems. But we are joined once again by Mr. Chris Hausman, the portfolio manager, a.k.a. the director of risk over there at SWAN Global Investments. Mr. Director of Risk, welcome back to the program. How are you guys holding up down there in the midst of a somewhat crazy hurricane season, sir?
Well, gentlemen, good to be back. And I do want to say that it is actually all quiet on the NOAA hurricane front. So there has been a tremendous volatility crush as far as storms go.
That's a good thing. I think we can all do with a little bit of that crush. When we had the double hurricanes in the Gulf, I just had to shake my head and say, what has 2020 come to at this point? Double hurricanes. There's no safe spot anywhere anymore. And then we're going to dial that handle of the clock all the way around back to, I do believe, South Florida, where he is hanging his hat. Mr. Eric COTT, the Director of Advisor Education, a.k.a. the go-to guy for all things advisor over there at the Options Industry Council. Mr. COTT, welcome back to the program, to you as well.
Thank you, gentlemen, and glad everybody is safe and sound. And I'd be remiss, Mark, if I didn't give a shout-out to our friends and colleagues and their families that are celebrating the 5781, the Jewish New Year. And coming up this weekend, everybody will be shedding their sins for the Yom Kippur holiday. But I want to thank Chris and Matt and you for the flexibility to have this on a Friday.
We got to do what we got to do, sir. And now it's time for us. We got to talk about the buzz.
Busy financial advisors don't have time to follow the latest developments from the options market. So we do it for you. It's time to get the buzz.
All right, everybody, welcome to The Buzz, the portion of the program where we break down all the latest development in the world of options and derivatives for you, the busy financial advisor, asset manager. Maybe you're busy doing your job, managing your clients' assets. You don't have time to pay attention to this stuff. So we do it for you. We're nice like that. And, of course, these days we have to kick off the show just kind of setting the table, seeing what's been going on from a market and from a volatility perspective since our last show, because every single episode now, more craziness has unfolded. I was only half joking about the double hurricanes, but that's just one of the many things that has unfolded over the course of the market since our last show. So a lot has happened out there. Let's go back around the horn the way we came. Let's start in the land of New Hampshire once again. Mr. Matt, what has been catching your eye? What has been on your radar from a volatility and from a market perspective, sir, since our last program?
Well, a nice healthy correction. Sorry for the longs, but we needed something to stop this just squeeze play to the upside. Our data caught it pretty well. We look at just slight upticks in the implied volatility, contango, and these forward volatility relationships. Of course, the VIX term structure is still crazy because of the election, and is the election going to even be over after the votes are counted or not counted? So that's throwing a little bit of a wrench into the calculations. But I don't know. I mean, I'm tempted to call a respite to this downturn. It's starting to feel a little calmer. Maybe it's just Friday. Usually I'm with you on volatility views, talking about earnings, but now we're talking about advisors, and I don't know. I think it's calmed down here, Mark.
Well, speaking of vol views and election volatility, like I said, we're just coming off this show because it is Friday, so I have the data in my hot little hands right now. You're talking, of course, about all things volatility term structure out there. And in the VIX futures curve, at least coming into that show, I'm sure it has morphed a little bit over the last hour and change, but at least coming into that show, we saw a little bit of an interesting change up out there in the space. The October future, still pretty bid, about 4-point premium to the VIX cash out there. The November future, about 5.25 points out there. That's about half a point higher. So the front portion leading into the election and in the immediate aftermath of the election, getting a little bit richer, a little bit juicier out there. But then D's future was about 3.5 points. That's almost a full point lower than it was this time last week. And the Jan future, which is the one that really kind of concerned me, if they're pricing vol all the way through to Jan, all the way through to Inauguration Day, that's really pricing in a lot of other shoes to drop for the economy, for the political spectrum, for a lot of bad things. And that had been pretty pricey. Now it's about 2.6 points north of the cash, which is over a point, about 1.3 points lower than this time last week. So maybe they're pricing in a little bit of saner, calmer normalcy in quotes post-election. We shall see. Mr. Chris, what are your thoughts on what you're seeing out there? And does this evolution of the term structure, do you agree with that? You think it's also crazy town? What's lighting up your tape over there as the director of risk, sir?
So I agree. The kink is making it a little bit challenging to get your backwardation contango type measurements in line. So what we've done is really looked at shorter term volatilities. I've said this before, with all the expirations that we have almost 35 different expirations in the SPX. The term structure can really be sliced and diced. When we were on the floor and you had 6 expirations, you traded a 6-month option, the 1 year was a good hedge. Or if you traded the 1 year, the 2 year was a good hedge. Well, if you trade a 3-month option, you can trade a 3.5-month option or an option that's only 3 or days or 1 week behind. So you really have sliced and diced this term structure. So if you look at shorter term areas or the front months, you can kind of see it went a little bit into backwardation like September 3rd, September 4th, but then it quickly normalized. And so we just went from an environment where we said this on the last show where it was spot up, vol up, and now it was spot down, vol down. So that kind of unwound. The risk premiums come in quite a bit. There was a huge risk premia during the rally. That has normalized somewhat. It's still a little on the rich side, but it's definitely nowhere near what it was before. I went back and looked at some VIX term structures for previous elections like 2004, 12, and 16. And you could see over the 10 years of the VIX futures curve, you're around 15 to 20. So everyone's probably shaking their head. Yeah, that's normal. 2008 was different where you saw, way longer term futures at 35 and the shorter term around 55. We all know what was happening in 2008. So again, going to the term structure that we're looking at right now, it's very, very unique with this election kink. And I'm seeing people play it both ways. I mean, I think something's got to give. It's going to normalize, and you're seeing people play it that way. And then you've got the other ones that think that, wow, there's some very, very real risk on the horizon here, and they want to still continue to be long volatility. So the other thing I want to mention about skew, and when we talk about skew, it's always downside puts versus upside calls. So I'm kind of isolating this one this time. I'm just looking at an 80% strike put, which is a put that's 20% out of the money, and then just looking at your at the money. So I'm isolating the put skew, and what we've definitely noticed here is that usually if you look at 3-month and 6-month put skew, that 80%, 100% strike or that 20% out of the money put at the money, they're kind of in line with each other. And what we're noticing is that there's a really big difference between 3-month and 6-month. So 3-month as of yesterday was like in the 8th percentile over the last year, and 6-month was in the 17th percentile. So that's telling me that even 6 months out, there's still a lot of people worried about tail events to the downside. Now, whether that's election related 6 months out from now, or it's where the hell's the economy going to be 6 months from now? Who knows? And I got to throw some technicals in there real quick here. I know we had a good correction. Watch in the SPX, the 50-day moving average at 33.5. That should act as resistance here. You've got good support at 3,200. 3,200 is where the COVID breakdown happened in February. That's also where the 100-day moving average exists. It is finding some support here in the short term. However, if that does break, I think we will test the 200-day moving average below 31.10. And I think that's when it gets a little bit more interesting to get on the long side here.
It's funny you mentioned those 3 and 6 months different put skews out there. We were just talking about something simpler on volatility views through the lens of some of the volatility products. Obviously, there's some crazy VIX options going up on the 75 and 150 strikes and par strikes and everything else. Also saw someone playing in VXX, which is a product that is known to erode quite aggressively, the June 40 calls of next year. We had to just get a good chuckle over that. But what would it take to make VXX north of 40 by June of next year? Nothing good for the country or for the economy, that's for sure. So a lot of weird things. Speaking of weird things in the election, before I toss it to Mr. Cott really quickly, we have a live poll going on right now that was inspired by volatility views, because this time around 4 years ago, we had a very interesting and fun live election night special. We kind of just did it as a lark. It was me and Dr. Bix and a few others out there. And lo and behold, we saw a lot of volatility as a result. Once Trump won Ohio, all bets were off. It was off to the races from there on from a vol perspective. So we thought, given what the election premiums being priced in, maybe might be worth it to revisit that. So we put a poll out there to our audience. Wanted to know if you guys want us to do that again, this time do a live election night special. Not going to get into the political he said, she said, none of that. We're just going to talk about the numbers and the markets and maybe have a little bit of fun. And so far, in the early voting, 100% of our audience says, yes, we should do it. So maybe we'll do something like that. I don't know. Matt and Chris, Eric, you're invited too. You guys down for something like that? Maybe pop in on a live election night special on election night. You guys up for that?
Absolutely.
I'm good.
That sounds fun.
Can I tell you a story about the last one?
Sure, go for it.
So no politics here, but I thought Trump was going to win. So, I got short and he won. And I'm like, oh, we just made like 30 grand or something. This is going to be great. Got up the next morning, market's unched. I'm like, what? And so I was up all night, I would have been, and so, that would have been great to be up all night with you doing that. And then coming in the next morning, you could watch the tears going down my cheek.
Yeah, I don't mean to laugh, but I laugh because I feel your pain. You're right. That was an insane night. I'll never forget it just because, like a lot of people, I had seen all the polling data, so it seemed like Trump had a very distant chance of winning. I very distinctly recall the moment when Mr. Rhodes, a.k.a. the once and future Dr. Beck, said, I think he just won Ohio. And that's when I really realized, wow, this thing actually has some legs. And it was, like you said, it was just off to the races from there. That's when the Dow sold off nearly 1,000 points and the VIX future started moving. And you're right. And it seemed like it was all madness. And then, of course, the sell-off came. And then we had 2017, which was a year that no one in a million years would have ever predicted. Vol just went away. That's the one thing everyone predicted about the Trump administration. Whether you liked him, whether you didn't, they said he's not a single-digit VIX president. And lo and behold, for quite a long time he was. So, yeah, that just shows how difficult it is to predict these things. But there you go. Listeners, I think we're going to have it in the bag. We're going to start setting something up. We'll make a nice round table of guests. If you have a suggestion for guests you want to come on or topics you want us to hit on, we'll probably be doing it for at least a few hours there. So it'll be kind of fun. You guys can pop in and pop out when you need a break from your heady political coverage. You can come to us and we'll turn the tables for you. Nice and kind of fun. But Mr. Eric, obviously been an interesting time for you guys over there in OIC and OCC as well right now. Every time we do a show now, it seems like we've got new records over there in OCC land. June, still the number one month in options history this year. July was number 3. It just got knocked to the dark side because August bumped it off. August is now the new number 3. Volume was up nearly 30% from this time a year ago. Year-to-date average daily volume right now, listeners, because all you guys can't stop trading options. You got options on the brain, which is great. Year-to-date ADV is 28.5 million contracts, up nearly 45% from this time last year. So, Mr. Cott, certainly a lot going on. I'm sure we'll have the numbers soon for September as well, probably something similar out there. What's been lighting up your tape and catching your eye since the last time we chatted, sir?
Sure, and I'm going to actually agree with Mr. Amberson, maybe for the first time now. I'm joking, actually. But I think that things have become muted, and at least in the advisor community, because interestingly, we're going into October, and I just did a couple of webinars with some of the exchanges and talked about how October 87, October 08, those are on the minds of advisors because we've talked about this in the show before where the median age of the advisor right now is probably in their early 60s. So, 87 and 2008 are fresh in their minds and clients are still concerned. I agree with Matt and Chris. I think, it was a sort of needed correction that we had. going to the weather analogy that Chris was bringing up, look, peak hurricane season's around the week of September 8th. However, we could still have some major storms in Puerto Rico and Florida. Chris and I could still be impacted dramatically in the month of October. So, look, I mean, advisors are still concerned about what's going on in the election, the economy, the pandemic. I don't know. Is this a contrarian thing? I'll mention this, that the governor of Florida now, Mark, has decided to open all restaurants in the state.
They're doing that in Indiana now, too. They're opening everything.
Is that something we should – is that like where we're seeing a muted, mid-20 VIX? Is that like you open restaurants, we're going to start to see a parabolic, 30, 35 VIX because restaurants are opening up and people are concerned? I don't know if there's a correlation between putting people in restaurants and what goes on in the markets. But, I think it was something that we needed. And to your point, Mark, yeah, we're seeing June as the historic month for OCC. Clearly, volumes are still increasing. Something the four of us have talked about last month and in other shows is about the retail investor who is at home is finding, based on this show, Mark, and all the information you're bringing out there, they're finding that they want to actually start to use options. They've been sort of long stock and long ETFs, and now what they're saying is, hey, I'm hearing a lot of things coming from that Options Insider Radio network, and maybe I should dabble in that. And so we're definitely seeing a lot more retail participation than we've seen in a long time.
That is indeed the case. I do believe we have a listener question about that in a minute or two. But first, we talked a lot of crazy macro. Maybe we'll dial it back, get a little micro for a second. Since we're talking broad volatility, let's go narrow single name volatility. It is still earnings season, listeners, even though I do believe the last time we had Matt chatting about it, he said it was the bloodiest earnings season for premium buyers that he's ever seen. I think it's still trending that way, maybe a little bit better, but let's get it straight from the horse's mouth. Mr. Matt, sir, what's going on from an earnings volatility perspective? Is it still a blood red season out there, sir?
Well, again, there's just not as much going on. And what we saw was, so bad with, COVID and, what I thought was going to happen is they were actually going to give some guidance. They being the companies kind of skirted those, and the option holders were left holding the bag. So whereas, lately there have been some big movers, Mark, it just continues to be, a bad earnings season. We do a lot of calculations, X earnings, and we do a lot of calculations about the kink in the skew. We're even doing an earnings calculation for the SPY for the election. It looks like 3.5% move on that day. So, but other than that, not much going on, and still, just the option owners around earnings are still licking their wounds, Mark.
Yeah, it's been a rough year pretty much on the earnings front to be a volatility buyer, and you certainly would have been forgiven coming into last cycle or maybe even this cycle to think, hey, I probably should own some vol because these things are set to pop off. Like you mentioned, Matt, no one's giving guidance. We're in a kind of a bit of a unprecedented period, and yet it's been exactly the opposite. I think the last time I checked your season report, Matt, it said it was an average of about 72% for the entire season now in terms of how much vol was priced in versus how much movement was actually delivered out there. And so clearly premium buyers are getting the short end of the stick out here. A lot has popped off in the market since our last show. In fact, hot on the heels of our last show, we saw a big announcement coming out of the Fed. We just missed it on our last show there. But it was interesting. I want to kind of get you guys' thoughts on this as well, because this is a sea change for the way a lot of people think the Fed manages the economy. Of course, going back to the dot-com days and Greenspan and his very infamous irrational exuberance comments and Volcker, and just pick about any Fed administration. And usually job number one for these guys is to be an inflation hawk, right? And then it kind of depends how inflation hawky they are, depending on their political leanings and everything else like that. But in general, that's usually job number one for the Fed. Powell coming out pretty much hot on the heels of our last show and saying, you know what, we're not really going to do that anymore. We're going to have what they quote, average inflation targeting, and implying that effectively going to take the brakes off the economy a little bit and maybe let it run a little bit. Also, they've said just recently on the most recent meeting saying they're pretty much going to keep those rates near zero for quite some time, 2022 and indeed beyond out there. So it's changed the game a lot out there. Chris, you were just talking earlier about some of the challenges of looking at things from an overall earnings vol perspective and getting things done a little bit longer term out there in products like SPX. How has the Fed kind of changing the way they govern effectively? How has that, if any way, how has that impacted what you guys are doing over there in SWAN land, sir?
Well, if you're dealing with longer-term options, one of the risks that you have to contend with is interest rate risk, row risk. It's the one Greek nobody talks about, and because for the last 10 years we've been essentially in a 0% interest rate environment. I mean, if you guys remember back in the day, we had to contend with 5%, 6% interest rates or even higher. And there were surprise cuts. There were surprise interest rate raises, and that affected option pricing. So the good thing is maybe that's one less variable that we're going to have to contend with, dealing with the longer term option and that row risk. So that's a good thing. As far as addressing inflation, they were going to have to address inflation here at some point with all the central bank easing that's been going around and this quote unquote easy money, especially saying that we're not doing anything to interest rates for the next several years. They had to address inflation in some way, shape, or form. And I think, 2% doesn't sound like a lot, but I think it's the first time that they're saying, well, we're going to keep an eye on inflation. Oh, and by the way, we're not raising interest rates for the next several years.
Yeah, when rates are already pretty much hovering around low, their tools, their weapons in their quiver are kind of limited at that point anyway. So they kind of were between a rock and a hard place in that environment anyway. But still, interesting stuff. I don't know, Mr. Eric, this one come across your radar as well? And is this impacting advisors out there effectively, this paradigm shift in what the Fed is doing?
I think, you guys have talked about this before about the Fed put and, and that there is this, understood idea that we're at a zero interest rate environment and there's so much money being pumped into the market. Clearly your advisors are paying attention to this. And, I think from, a macro standpoint, yeah, it's something on the mind of advisors, but, it's one of these things like, you just keep hearing, don't fight the Fed, and advisors are still focused on rebalancing. The response I get, or at least what I've heard, and I mentioned it on here, a few months back, is that they're and I'll quote Greenspan, from decades ago. They're cautiously optimistic advisors right now. We talked about it, early on in the show, about all of the things that are going on in the economy globally. When maybe this vaccine comes out. Matt was saying, which I love, we're not going to talk politics here, but what's going to happen in Washington on November 5th? What's going to happen in January? Chris talked about it. So I think the Fed as an overall situation, Mark, definitely is part of a conversation that advisors are aware of, but I don't think it plays into as much as, say, the sell side community is following it.
Well, speaking of that community, there's been some disruptions over there in terms of the derivatives side of the space. Couple of not the best headlines coming through from the banking side. First, JP Morgan, again, this has been a hot topic of the last few years out here in the derivative space, particularly on the future space. Spoofing, it's the hot thing. All the reg tech startups are really going after that to try to find ways to analyze it. It's, of course, a difficult thing to really get a handle on, particularly when orders are flashing in sub-second increments from algos and they're canceling and replacing. Spoofing, of course, effectively stuffing the book, listeners, trying to drive paper in one direction. We don't really have any economic intent of doing that. You're going to cancel the orders immediately. Well, Morgan getting hit with a huge fine, $1 billion or close to it out there. That pretty much blows the doors off any other recent fine in the spoofing related space out here. It was primarily in a couple of different areas and mostly in the metals desk. They termed it a criminal enterprise, and they actually used racketeering laws to go after these things. They say effectively the metals desk at JP Morgan operated as a criminal enterprise for 8 years. And I guess the penalty reflects that. $1 billion, not indeed chump change. And now, of course, there are similar investigations going on in JP Morgan in their Treasury futures desk over there. So not exactly good headlines coming out of Morgan on the futures and market making side of the fence. And if that's not enough for you on the market making side, Citigroup also deciding, even though we're just talking about retail options palooza and what's going on out there, Citigroup deciding to get the heck out of Dodge when it comes to that business, saying they're shutting down their market-making operations for a lot of retail-centric clientele out there. They'll still have the institutional desks, so they'll still match orders. If you come to them and you want 1,000 or 10,000 or something, they'll take the other side of it for you or find that for you. So they'll still do that. But in terms of like their retail market making, they said they effectively wanted out of that arms race. It's an extremely expensive business just to keep up with the Joneses. We've heard similar things out there from other guests on our network over the years. Petterfee, when he got rid of Timber Hill, and Blair Hull, famous market makers in the space have come in and said, it's just not really worth it to try to compete these days. The barrier to entry, the costs just to be competitive are so high, so onerous. And Citigroup obviously deciding that was the case and getting the heck out of Dodge as well. So unfortunately, two somewhat negative headlines out there in the space. Hopefully, if you're doing some size, Citi will still take care of you out there. But this is an interesting one. I don't know, Chris or Matt, any thoughts on these two kind of somewhat negative headlines in the derivative space, picking on the market-making liquidity side since our last show, gentlemen?
I'll take a shot, Mark. And I think that J.P. Morgan relates to what's happened in the silver markets and the gold markets. I think that they were, really sitting on silver especially. And so now that they're gone, I think we're going to see, more higher prices in silver potentially and potentially more volatility in the metals. This market making environment is scary to me. I was one when there were thousands of us, and now maybe there are 5 or 6, and it's so difficult to keep up. There's so much of the order flow that's now internalized. One of the latest things that ORATS is doing, we have this live data feed through a partnership with Tradier Brokerage, and we're able to sit and see. We have our theoretical values that are really good, so we could see if there are good orders coming in. And I thought we'd be seeing them all day long, but there aren't. They aren't really moving the market when they're trading, and it's a strange market out there. If you look at ROBINHOOD, there's this report called the 606 report that shows the payment for order flow, and they've come under some fire for that as well. Hopefully all this cleans up the market and makes it a stronger market, but that's what we could hope for. But there's some, I don't want to say dirty dealings, but dealings that aren't in line with the strong market that we all have come to love, Mark.
Let's see if we can build upon that strong market. Let's turn the news positive a little bit, because if you want more players in the game, particularly when it comes to stock, well, then this is a good day for you, and indeed a good couple of weeks out here. First off, our friends over on the Volatility Views program, MIAX, launching a new equity exchange, Pearl. So I guess 3 options exchanges wasn't enough for them. They'll add an equity exchange. They picked up MJEX, a futures exchange. They're getting into the crypto space. They've really been firing on all cylinders over there of late. So that's a new launch, as well as, of course, the long-term stock exchange going to launch on Wednesday, and this much ballyhooed members exchange, which has a lot of big players associated with it as well. That's going to launch on September 21st. So a lot, actually that did launch, on September 21st. So a lot going on out here in the exchange space. I know, Eric, as a part of OCC over there, this has been on your radar for a while. What are your thoughts on the increasing, we always talk about the fragmentation of the options space, but the equity space, pretty darn fragmented as well, sir.
Well, it is, Mark. Look, we've talked about it here where, Box had an open outcry exchange a few years ago, and we have 16 exchanges that I represent, on the listed option side, and it is hard to believe. There are 13 stock exchanges, and do you need more? I guess. It's a good time. I'll sort of I'll quote from a story that was out there. As a colleague of my brother over at Piper Sandler, Rich Rapet, who I think Mark, and probably Chris and Matt do, that do you really need them is what Rich was saying. But look, it's a way maybe to kind of lower costs. So you've got these exchanges being added, and timely from our friends, Mark, at MIAX, because all 4 of us know Trisha Pearl, who is over at OIC and runs the conference. happens to be the weekend. It happens to be the birthday weekend of Trisha Pearl. So what a good time for the MyX folks.
The MyX folks did tell me they named it after her.
Well, they did. I mean, I'm sure Matt and Chris are laughing because the last conference all four of us were at was at the Doral. That was a MyX, their kickoff conference for the industry. And so here they are giving Trisha Pearl a gift with the Pearl Exchange. But yeah, look, it's more competition. I mean, I think we've all talked about it, and I don't know. I mean, do we see more? Listen, I'll ask you guys. Do you think we see more option exchanges in 2021 and 2022?
I think they're getting a handle on what the hell they have right now. I'd be hard-pressed to see more listing. But, hey, I've been surprised before, and we're being surprised on the equity space. So maybe MyX wants a fourth options exchange. I don't know. I can't keep track of who has what anymore over there. But if you're talking about more competition, Eric, you came to the right place. I know this one also came across your radar since our last show. One of our common themes here on this program is we kind of lament the dearth of options-oriented funds. We kind of joke about how small the Morningstar options-oriented fund is. You got Gateway, you got, of course, our buddies over here at SWAN, then it kind of all really falls off the radar from there, and they lump them all together. Funds that don't really have anything to do with each other are all kind of lumped together because they're options-oriented. It's a huge mess. But if you want more of a mess, if you want more funds out there really coming in and offering more opportunities, then perhaps you'll be excited. A couple of new additions to the space. First off, Global X ETFs. And they're interesting ones. They're different than what we've seen. Global X ETFs adding a covered call suite. You might say, covered call. What's the big deal? This one has a little bit of a wrinkle. If you said to yourself, I don't like clipping all my upside with selling the covered call like straight at the money, let's say 10% out of the money. I want maybe half of my upside. That's what Global X is giving you here. They're doing a portfolio that holds the underlying and writes at the money calls for 50% of the portfolio value. So they're giving you some income and some room to run on the upside, which is, I give it to them, it's certainly different. I haven't seen a fund do that before. Whether that's worth doing or not, that's up to you to decide. But it's an interesting one nonetheless. That joins a lot of their other family of covered call funds, which effectively do what you expect. They write 100% of their portfolio value at the money strike. So they're mixing it up a little bit. They probably see the market has been running for a while outside of the last couple of weeks. So having a little bit more room to the upside may attract some investors. And speaking of upside, just had an interesting conversation with the folks from TrueMark Investments. In fact, if you're listening live, listeners, we just beamed that into the chat before this show started, and they're doing a effectively bullish risk reversal fund out there. So if you wanted to sell puts out of the money and maybe buy at the money calls in major indices like the S&P, that fund's got you covered as well. So Eric, it's been an interesting month or so on the options-oriented fund side of the space. Would you agree, sir?
I would agree 100%, and I would give a shout out down south to Chris and my friends at SWAN because, they have been colleagues and they were kind of on this sort of cutting edge of going from this separately managed to this 40 Act and starting to really kind of offer it as a broad investment theme. So, Rob and Randy and Chris and Mark, all those folks down there, kind of saw the opportunity. And it's something, Mark, you and I talked about back in 2009, when I was coming on board, that the growth and the parabolic acceptance of using options was going to come when sub-advisors started to offer strategies that either mitigated downside risk or managed upside and offered alpha opportunities and or combined it and looked at concentrated positions. So this is exciting, and I really do think that we're going to see more of this happen. I mean, there's collaborations between firms. And, I'm agnostic, so I'm not one to endorse anybody. But hint, hint, we have a firm that's on this call right now that you can hear a little bit more about. But I think across the board, whether, Global X, you're talking about TrueMark, SWAN, et cetera, what it does is it offers the opportunity for advisors that might specialize in something that could be fixed income related or elsewhere and really thought that, offering an overlay strategy to their clients, but bring in a professional manager to do that. So I'm excited by it. I mean, look, the Morningstar, as you said, has I think over 180 right now in terms of ETFs and SMAs and 40 Acts and closed-end funds, et cetera. I think that is one of the themes we'll see through next year, Mark, is more of these types of strategies in a sub-advisor platform.
Well, Mr. Director of Risk, you have been invoked. You know this space better than any of us because you live in it day to day out here. And it's certainly been an interesting space to watch. How many times on this program over the years have we kind of wrung our hands and say, well, listeners have asked us directly, why aren't there more funds playing in this space? I know you guys at SWAN have done your due diligence, not just on a show like this, but doing the 10th box to try to get more advisors and firms out there doing these kinds of things. Maybe not these exact strategies, but hey, to each their own. So they certainly are interesting new wrinkles to the space. First off, a 50% covered call fund. So if you want a little bit of upside, a little bit of income. And then the other one that really caught my eye, like I said, we just had them on the network this week to discuss it, was the bullish risk reversal fund, effectively selling, I think it was like maybe 25% out of the money puts, or maybe even closer to out of the money, and then buying an at the money call, which is an interesting one in and of itself. What are your thoughts on maybe these strategies and in general the overall expansion we're seeing, Chris, of the options-oriented fund space?
No, the ETF creations recently has been this has been a hot space with all these structured products coming out in the options world. And again, you touched on a couple of different strategies, but you can really be as creative as you want and produce a product for an investor. So there's a whole suite, a whole line of different type of risk tolerances for different investors. And that's the first thing you have to, if you're an advisor, the very first thing you have to figure out is what kind of risk tolerance can my client handle. And then after that, then you can start feeling them out. Okay, well, you get a little bit more specific about, well, what's your downside risk? What is your upside risk? Like the example you have, I don't want to give up all my upside, but I'm okay giving half my upside. That's great. Traditional structured products back in the day when banks created them in a high interest rate environment. Well, what do? They put a bunch of money in a fixed income product. They took that interest and then they just bought calls on the S&P 500, and that was a traditional structured product. Today's structured products, because those don't work anymore because there's zero interest rates, today's structured product is doing the opposite, and this is why we learn put call parity and all these old formulas, as market makers, is because now they're taking the dividend, really. They're taking the dividend and they're saying, okay, I'm getting X amount of money in a dividend. I'm going to go ahead and buy calls or put spreads or what have you when you're structuring these products. So it's kind of a shift here based on market dynamics where you've kind of put almost out of business the traditional bank structured product that needed that interest to buy free calls, if you will. And now option traders, ex market makers, people like ourselves are now saying, wait a minute, we can take that dividend and create a structured product and offer that to advisors and investors. And I do want to touch back on the whole market making thing. Technology has always been a disruptor. The first piece of technology that hit floor market makers was when a guy showed up with a piece of paper with theoretical values written on it. And so it's something that has changed the environment. Like Matt said, there were thousands of us down there at one point in time, and you could see as technology got better and better, there was consolidation to where there's pretty much nobody on the floors anymore, and you've got the market structure that we have today. And I can't believe we haven't talked about this one, Eric. You sponsored a very, very good presentation from Mr. Henry Schwartz from the SIBO about all the market dynamics and volume. And I thought it was one of the best presentations I've seen. And just going with how market structure has changed here is that you're seeing an increase in smaller sizes, right? 10 lots and lower, or 11 lot to 100 lot. And also you're seeing the average volume. And all this, I'm just repeating what I saw in this presentation. So this isn't anything I figured out. And I'm going to give kudos to you guys from putting this together. So you're seeing average daily volume or the sizes under a 7 lot. And so, the first thing when I saw that is like, okay, if I'm a market maker and I'm getting pinged with 1 lots and 5 lots and 7 lots, I'm going to back off my size here and I'm going to show 1 lots, 5 lots, and 7 lots because I don't want to get run over in the volatility. And that's kind of what happened, the last few weeks. We had vol go up and spot go up. Market makers were getting run over by this influx of all these small orders. So they backed off, showing smaller orders, and then we go to Matt's favorite topic of liquidity, and then there's potentially another hole in liquidity that we're going to have to deal with. So in other words, you see market dynamics continue to change, and all that does is put more uncertainty into the marketplace.
You know, Eric, Chris brought up a great point here, which we've been so buried in topics we didn't even get to. You guys have been pretty busy over there at OIC and OCC hosting a bunch of interesting webinars, you know, managing volatility. Of course, the Henry Schwartz, he typically does the state of the industry, state of the union kind of update over there at the OIC conference. Obviously, no OIC this year, so he was able to do it virtually. So a lot of great nuggets, like Chris just pointed out. Want to give us an overview of some of those recent events and some of the interesting takeaways there, Eric?
Yeah, and Chris, thanks for mentioning that. And, you know, again, all four of us have sat through what we always feel is a great presentation. I mean, Henry delves into the weeds.
All right,
I mean,
speak for yourself. I'm not going to praise that Schwartz guy.
Well, again, yeah, I mean, obviously the highlight of any conference, the OIC conference, is the interviews with OIRN and cracking open the beers and smoking the cigars with Mark. But if we put that aside, it's Mr. Schwartz getting up there and giving us the state of the industry. And yes, so now that he is a part of SIBO, since they bought his company, this was hosted by SIBO, and Henry gave, his sort of predictions on where volumes might be. I mean, I think there was a $6 billion volume prediction made, early this year about where we would be OCC cleared volume. But, you know, the smaller lots and things like that, is definitely something, as Chris, you mentioned, that they're paying attention to. And Henry talked also about, you know, the onslaught of Robinhood and other firms and the participation by retail. So there was a lot of things that came out of that. It was really kind of interactive. And, I'll talk later, Mark, about, just some of the things on the advisor side that I've been doing. I unfortunately wasn't able to kind of participate with that because I was doing something with another exchange. But, we got great reception to that, and I would say that given the predictions, maybe next year it's going to be a hybrid, maybe a virtual and a live conference. It's hard to say.
Well, since you touched on all the Robinhood goodness, we got some questions on that. And the listeners have been hitting us up en masse. We got to get some of them on the show. So without further ado, it's time to put out our shingle and open up the office hours.
It's time to answer your pressing questions about options. It's time to start our office hours. You can become a part of this segment by leaving a question on theoptionsinsider.com, emailing us at questions@theoptionsinsider.com, or via social media at twitter.com/options, facebook.com/theoptionsinsider, or stocktwits.com/optionsinsider.
All right, everybody, welcome to our office hours, a portion of the show where you guys take the reins. You guys have been doing your darndest to deluge us with questions, see how many we can get to. Eric just kind of invoked the first one here. This comes from Nick Jack. He's talking about that same topic a couple of you have mentioned about Robinhood. He says, hey, guys, a great breakdown of the Robinhood tragedy. Oh, yeah, he's referring to our recent show where we talked about just a little bit of a knowledge base in our Options 101 about what happens when you're actually assigned early on puts and put spreads. Don't panic. Understand what's going on, and hopefully don't follow the tragic example that Robinhood customer actually took his own life because of effectively erroneous error and margin messages there. Nick Jack says, I think I finally understand the problem now. But he says, as an addendum, this doesn't look like this is really eating into their earnings, though. See attached, and he put a link to the article you guys are just referring to, which has really been causing a bit of a firestorm in the industry of late. This came out pretty much right after our last episode, saying Robinhood reporting more monthly trades than rivals Charles Schwab and E-Trade combined. Now, the vernacular in the brokerage business, listeners, is DARTs, daily average revenue trade. That's the lifeblood of the brokerage business. If you don't have DARTs, you don't have a business. And so they measured that and saw Robinhood doing 4.3 million DARTs per day, obviously daily, in June. That's outperforming all the other publicly traded brokerage firms combined, pretty much. This is the first time they've started publishing their data, and of course, obviously on the heels of the Robinhood tragedy and a lot of negative PR being shined on Robinhood. Of course, they've had a lot of outages of late as well. Yeah, that's more than all the major incumbent firms and more than E-Trade and Schwab combined. TD Ameritrade was number 2, 3.84 million DARTs. Then IB, 1.8 million, and so on and so forth. So yeah, Nick Jack pointing this out. You're right, it is an interesting trend. They don't seem to have been negatively impacted. It's kind of interesting and or dubious to call them revenue trades when they're not really charging any revenue for a lot of these trades. But of course, they're getting paid on the back end, which is another contentious issue out there with Robinhood. But it's a pretty interesting point. It's kind of a good one that Nick Jack makes here. Maybe we'll start with Matt about whether, all this negative PR, all this negative publicity, all the options, headlines, and the problems that Robinhood has doesn't seem to be impacting them, Matt, from a overall darts perspective, sir.
Yeah, I mean, you have just traders out there buying call. The market's going up. They're making money. They're buying more calls. They're getting checks from the government. They're buying more calls. And we're seeing the same thing. We've never seen Apple, for example, their put-call ratio so low. Since we've been measuring it, our data goes back to 2007, and so they're just call buying. And as Chris said, at a point there when the market kept going up, the market makers had to just start getting out of the way. Their gamma starts kicking in against them, and they couldn't float anymore. And the Robinhooders kept buying and buying. So yeah, we're seeing that same thing. And then, it just makes me think of that. I wish they, the market, the exchanges would think of some way to do a flex. So they would, so many of the retail traders are worried about assignment, and there has to be a way that they could get around that worry. And I think they'd see a lot more trading. So, maybe sell the idea, but do a flex option where they put the exact same strike back in your account, take the stock out, so you don't have to worry about that the next day when you come in. You don't see negative 700,000 in your account. So that's what I think about when I see this, Mark.
Well, Matt, keep your question and answering pants on, because this next one came in specifically for you. Apparently, you're developing a bit of a fan base here. The rest of us will go pound Sam for a little bit while you answer this one that came in for you. This is from Michael Smith. This is going back to what we were talking about earlier with the underperformance of earnings, straddles, and volatility. Michael wants to know. He says, Matt, do you think the underperformance of the earnings straddles is due to the run-up into the event? Take a look at Crowd, CRWD, which is, of course, a ticker for CrowdStrike listeners. He says up 23% this week, and the at-the-money implied vol is up to north of 100 from the 75-ish range. Seems like many of these are decently priced a week or so out, then just take off. So, Matt, this is right up your wheelhouse. So what do you have to say here for Michael and his question about CrowdStrike, straddle, and volatility?
Yeah, at Tanny9, I responded to this. I think this has to do with the last question that we got about the Robinhood. I mean, what's happening is the earnings is becoming less important because everyone's just buying these stocks, and they have this momentum going, and as the markets were going up into that last earnings season, what was happening is it was exacerbating itself. Short sellers had to cover. The market makers who were short the out of the money calls were getting short gamma. They had to cover and chase the market, and it all fed on each other. So I agree with them. I think that all of that rally really muted the earnings moves because it was made the earnings just not important. All that was important is buy. The market's going up, and these Robinhood traders aren't looking at earnings. So it's just, it takes, I think it's actually unfortunate in this because you want a market that's, really looks at the fundamentals as well. But now it's just the technicals and momentum. And so I think he's got a good point there, Mark.
All right, next up, another named question. This one from DP Tech. This is for Eric. He says, this question is for Eric from the Options Industry Council. Well, I guess we're just a personal question-answer line here. We love when you guys target your questions to individual hosts here. He says, are there any plans for additional certificate programs in 2020? Also, how large is the OIC advisor team? I'd imagine it would take more than a few of you to cover the full advisor space in the United States. So that space is a little bit more contracted these days, Eric, because you do all of it virtually. You used to be the road warrior. You were on the road pretty much every day of the week. These days, not so much. So maybe that's made the job a little bit easier. But we have to say here for DP Tech, he wants to know about your upcoming certificate programs, if you got any, and also what's going on. Well, how big is the OIC advisor team, sir?
That is a great question. Yes, things have changed post-COVID. So we are doing a lot more virtual. I just finished up actually two really well-attended webinars, which you can find on the exchange websites, and want to thank OIRN for promoting those. We did one on option strategies for advisors with NASDAQ a couple of weeks ago, and then we did one on alternatives to structured products with the folks in your backyard, Mark, with the SIBO folks there, where we had some portfolio managers from some I won't name names, but some from that Morningstar list. So we're constantly kind of aligning ourselves with exchanges and member firms to bring more content directly to the advisor. I am slightly bullish and cautiously optimistic that we will be back out there in the field. I'm hearing a lot from advisory firms that they are starting to get their advisors back in offices. They're starting to not only have Zoom and virtual calls with their clients, but they're actually getting to have clients come into the office. So, on the certificate program, that's something that we did with the Investment Wealth Institute folks that are out in Denver. Which is a great course. We are also building out the LMS, which is an OIC platform, which is not only going to be for advisors, but not only for retail, but for advisors as well as institutions. So, I have to say, Mark, Jim Hyde at NYSE once said he wished he could replicate Eric Cott and have more of them covering the country when I used to do these forums at the floor of the New York Stock Exchange. That was a very thoughtful comment. I don't think any of the three of you guys would like to see more of the caffeinated Cott out there. I think one is enough.
I don't know if the world is ready for that, sir.
One is enough for the industry, guys.
That's a lot of caffeinated energy leaching into the space there. So, yeah, he's kind of a one-man army for now over there at DP Tech. But, yeah, maybe we'll get a clone machine going, and then certainly that would be the nadir of 2020 when we have the Eric Cott clone army running around and taking over the country. All right. Next up, Charles, Mr. Director of Risk. This is right up your alley here. He's asking, this kind of alludes to what we were talking about earlier at the top of the show with the volatility term structure. He says, extended volatility term structure around the election caused problems executing SPX trades in the farther out months. Well, Mr. Director of Risk, you live in the farther out months of SPX on a day-to-day basis. You're also just talking about comparing and contrasting 3-month versus 6-month put skew out there in SPX. So obviously this question is near and dear to your heart. What do you have to say here to Mr. Charles? Are you having a hard time getting things done, sir?
So I'll preface that by saying the SPX is one of the most liquid products in the world. So that's a good thing, okay? And honestly, if you ever want to get something done, that's one of the better pits. So just from pure execution, that's not the issue. It's never been the issue. And I've said this on the show many times. Kudos to all those guys that, when they left the floor during the COVID thing, they were able, and the liquidity providers upstairs were able to, get it done as, because that was new to everybody. So there really weren't major issues at the time. I think the question really is he's talking about the term structure is this dislocation, is you've got theoretical values and what things should be worth. But at the end of the day, option pricing is based on supply and demand. That is what volatility is. It's supply and demand. And we saw it with the Robinhood traders, if they're the ones really creating this, and vol going up when stocks were going up and everyone was asking, well, that's not supposed to happen. Well, my answer was always not usually, but remember what volatility is. It goes back to basic supply and demand. So I think it's you have to have an assessment of where future supply and demand may or may not be. And that's in a nutshell how you model that volatility, because, obviously this kink is there. At some point, that kink will not be there. Something's got to give. Either there is going to be some huge event with the election, or you're going to see a tremendous, unfortunately with the COVID and the economy, you're not going to see a tremendous vol crush, but I do expect volatility to come in after the election. It's basically as we check off these unknowns on our list, volatility will come in. Maybe today, see, there's a pretty good vol downdraft in the VIX today because of the rally. Well, we just bounced off support, right? Matt said it earlier. I think this could be a short-term bottom or something like that, to paraphrase what he said. So again, it's supply and demand, and that's what you have to kind of model and try to get that crystal ball or try to figure out what's going to happen in the future. So again, it's always easy just to do simple execution in the SPX because there's so much liquidity in there. But the trick is, all right, where are these things going to be worth in the future? And how have I priced that, and how have I factored supply and demand into the equation?
Now let's take it home with this one, because it's kind of a fun little thought question that speaks to the theme of this show. This comes from Goose86 He or she wants to know, how many advisors do you realistically think use options? 1%, 2%? Well, I think it's a little more than that, Mr. and Mrs. Goose 86. Luckily, we have the guy on the show who commissions all these studies and did the recent Cerulli study and everything else. Mr. Cott, what do you have to say here for Mr. and Mrs. Goose 86 and everyone else out there in the audience who's kind of wondering about this? You have the hard data, sir. What do you have to share with them?
Well, I like the Goose name because I think that they're supposed to be coming out with the Top Gun soon. So one of my favorites.
You're right.
I mean, one of my last trips pre-COVID was out there in San Diego at that famous place where Tom Cruise was singing. I won't sing for your listeners, Mark. I don't think anybody wants that. But
it's bad enough we have clones of you coming. We don't need them singing too.
Yeah, we don't need that. The Cerulli study done in 2017 still has some legs, and in terms of, giving an overall view of the usage by advisors, I think we need to go and couple that with the conversation we had, 20 minutes ago about more of these overlay strategies. So you have advisors self-directing, doing their own, single name positions, but you also have advisors that are using managers who are running strategies, buy rights, cash could put strategies, etc., in a sub-advised platform. So, out of the 300 and some odd thousand advisors that are out there, Mark, I can't put a definitive number on it, but we're still only scratching the surface. It really is. It's not become mainstream, and I think that's why this show is so important, and it is why what Matt and Chris do at their firms imperative to the advisor community, because all advisors should be talking about it with their clients right now, because option strategies provide solutions in any market. I've always felt that.
Well, there certainly is more room to grow there on the options-oriented advisor space, Goose 86 and everyone else out there who has similar questions. Unfortunately, that music means we've run out of room to grow, at least on this episode. It's crazy how fast an hour flies by. We're talking so many things have happened just since our last show, let alone getting to all your questions. We could spend a whole episode just doing that. We have so much fun. You guys take us in so many interesting directions. But before we go, let's go back around the horn. Let's start once again with the Oracle of New Hampshire up there in the far-flung and still warm northeast up there. Mr. Matt, if folks are intrigued, they want to ask you questions like some of our listeners already did about the earnings vol reports. Maybe they want to check out a back test or two, or maybe they have some other questions over there. Where should they go? What should they do, sir?
Yeah, we've been very busy at orats.com. We've gotten a client that's looking to use option information to pick stock direction and AI. We got a lot of advisors coming in and wanting technology to help do the trading even now that we have this live data. There's a lot going on over here. So come on. If you haven't been here in a while, there's a lot of new stuff as well. orats.com, Mark.
orats.com, listeners, just orats.com is the place to go for all that great data and a lot more. If you want to see some examples of that in between, of course, you can check out their earnings move results, and earnings season reports over there at theoptionsinsider.com as well. You can't beat the price. It's completely free. It's great data. If you're trading in and around earnings and you're not looking at these things, I don't know how you're doing it. So check it out. The last time we saw this kind of data was like a Goldman study from like a decade ago. So really breaking new ground over here. And it's all great stuff. Orats.com is the place to go. And of course, we're talking about options-oriented funds. The folks at SWAN have a thing to say about that. Mr. Director of Risk, sir, what's cooking? What's going on in the land of SWAN? And if folks want to learn more about the DRS or maybe check out some of the content you guys have cooking, where should they go? What should they do?
Yeah, so we just have two pieces out recently, Market Timing Whiplash and Preparing Portfolios for Uncertainty. So the common theme is that, we're in an unpredictable world, obviously, right now with fat tail events both on the left side and the right-hand side. So investors should be wary about timing the markets. And if you are in the markets, a hedge portfolio can greatly reduce volatility and enhance returns over a full market cycle. You can check all that out at swanglobalinvestments.com.
SwanGlobalInvestments.com. They have their newsletter, their blog, their white papers, links to a cool show called The Advisor's Option. What more could you ask for from a website? SwanGlobalInvestments.com is the place to go. And last but not least, he is the leader of the forthcoming Eric Cott clone army. He's also spending his daytime moonlighting over there at the Options Industry Council. Eric, if folks want to learn more about what you guys have cooking over there, where should they go? What should they do?
Optionseducation.org, Mark. 888 Options. Encourage people to definitely leverage, no pun intended, the great resources. And I'm going to give a shout out to Chris and Swan for the great research they have, and a shout out to Matt at ORATS, because the technology and all they do there, more and more advisors are finding it to be a valuable tool as they interact with their clients during these volatile times. And lastly, Mark, you did a super job. The shows just keep getting better. I listened last night. I couldn't sleep. I put on the episode, and it helped me to sleep.
We knocked you right out. There we go. That's what we're going for here on the network. Where you can't find your NyQuil. We'll knock you out here at the very least. That's our goal over here on the network. Of course, check them out, what they have cooking over there, optionseducation.org, to learn more. And on behalf of Eric and everybody over there at OIC, and Chris, a.k.a. the Director of Risk, and everybody over there at SWAN, and Matt and everybody over there in ORATS land, and indeed myself, I thank all of you out there for downloading, streaming, subscribing, for sending in so many great questions. Keep them coming, for listening live, for all the fun stuff that you guys do. Keep it coming. And we'll see you back here next time for another episode of The Advisor's Option.
You've been listening to The Advisor's Option. The Advisor's Option is brought to you by the Options Industry Council. The OIC was created to educate investors and their financial advisors about the benefits and risks of exchange-traded equity options. For more information on how the OIC can help you implement options in your practice, please visit optionseducation.org. The Advisor's Option is also brought to you by SWAN Global Investments. Since 1997, SWAN has been the leader in hedged equity and option income strategies with GIPS verified results. SWAN provides unique and valuable solutions to the inherent weaknesses of asset allocation, offering defined risk strategies that allow upside participation while also protecting advisors and investors against market risk. For more information about our advisor program for separately managed accounts, SWAN Defined Risk Mutual Funds, or our proprietary option overlay strategies, please contact Randy Swan at swanglobalinvestments.com. Think outside the style box. Think SWAN when deciding on risk management solutions to market risk. The Advisor's Option is also brought to you by Option Research and Technology Services. ORATS is your source for options backtesting. It's where you turn your ideas into results. Founded on the floor of the SIBO over 2 decades ago, ORATS is a full-service option research firm focused on helping you develop options strategies in line with your investment objectives. With a state-of-the-art backtesting platform, scanning, and implementation tools, ORATS offers end-to-end option strategy development, making the whole options trading process easier. For information about backtesting, scanning options data, including dividends and earnings, visit orats.com or email Matt Amberson at matt@orats.com. You're listening to the Options Insider Radio Network, the home of the Options Podcast. For more quality options programs, visit theoptionsinsider.com or search for Options Insider Radio Network in your podcast provider of choice. Listeners can also access all of our programming through our mobile app available in the iTunes and Google Play stores. Select programs are also available via live stream at mixlr.com/options-insider. That's mixlr.com/options-insider. Don't forget to follow along with your favorite programs and submit your own questions for the hosts at twitter.com/options, stocktwits.com/options, facebook.com/theoptionsinsider, or via questions at theoptionsinsider.com.